5 o'clock. Get everybody to stand up, please. Like everybody to stand up. What I'd like you all to do for a second is to say hello to the person next to you. But wait. I want you to say hello to them as if they don't matter to you. And let me tell you why they don't matter to you. You're never going to see them again. They're probably not going to buy anything from your company. They're therefore not in your general ledger or your accounts receivable. There's nothing to bill them for. They're not an asset on the books and records of your enterprise. Say hello to them as if they don't matter. Go for it. Oh, that's good. No cheating. Wait. No cheating. That team over there is doing really well. Look at them. Their hands are in their pocket. They're not doing anything. It's just great. And before I ask you to sit down for a second, let me ask you another question. When you walk into a store and they ask you, how can I help you? What do they really mean? Repeat it again, please. What can I sell you? So do you really think they want to help you at all? No. I'll take a seat. We'll return to the exercise again. So if you think about it for a second, I'm going to ask you all a question. Bill already started the journey for you. Today, it's 2014. You're here for a reason to be the next CFOs. And I presume one day when you're the next CFO, they're going to ask you the same question every board asks me all the time. How do we create more shareholder value? And the CFO should be part of that dialogue and have a point of view. So let me ask a question. When you're the CFO of that company, what are you going to say? How do we create more value? Anybody any ideas? You're sitting in a board meeting. We're in executive session. The chairman of the board or the audit committee says, what are you going to do? I need to drive my stock price. What's some ideas we have? Sure.
We're going to build more assets and cut more costs.
There you go. Hands up. What's your name?
Glenn.
Glenn. Can you please stand up, Glenn? And please give him a round of applause. We know that. And the first thing we're going to do, you know, Glenn, sit down, is we're going to fire Glenn because he's an expense and probably has a high salary for that to boot. So all expenses go under the Glenn regime. Cut those high, paying expenses. Get rid of those guys. That's a good one. Anything else we're going to do? Sure. Generate some more services to sell. Very good. Anybody else have some ideas? And first, can you stand up again? Thank you. Take a bow. Handshake. Thank you. Very good. Okay. What other things can we do? Go for it.
Do a tax inversion and
Fantastic. Anybody know what that is? Can you please tell them what that is, a tax aversion? There you go.
I don't know if I know.
Go ahead. Give it your best shot. What is it?
Essentially, it's changing your headquarters to a low tax jurisdiction and minimize your tax.
Sure. Let's move our corporate headquarters off. This is great work. Let's hire some really expensive lawyers like Wilmer Hale. Let's move us off, location and get them off to China, wherever the next low tax authority is, and let's not pay our taxes in the U.S. And we also have some good ideas. Create more cash flow, but how? Cool. Sell more of the same things we've been selling all along and hope for the best. Absolutely. Anything else? There's an interesting idea. Invest in some more intellectual property, such as? Cool. There's a Salesforce guy. You got an idea for that? What's your name again, Salesforce guy? Yes. That's his answer. Yes, absolutely. Good idea. Yes.
If I knew I would be in finance.
There you go. Your answer. Help him out.
It's about driving customer success, creating more opportunities to create more customer success.
Fantastic. More customer success with some intellectual property. Any other ideas? Buy some more stuff, other companies, mergers and acquisitions. Anything else? Change the perception of the marketplace. But how do you do that?
Create new value and perception of value in the marketplace that your shareholders think is valuable.
You'd have to change the perception of the market by doing something different. I mean, it's nice. I might want to say to my wife, God, honey, I really changed. She says, do you know what date my birthday is? I have no idea what our birthday is. And but honest to God, honey, hopefully, I've changed my perception. Not really. You have to do something different to get a change in perception. Markets don't just change because you say, I want to change. So let's just take a little journey and see if we can tell you the answer. Bill's already told you there should be 5, but there's been essentially, in our lifetimes, 5 major technological revolutions. Agrarian, industrial, services, informational, and now networks. Anybody want to give me a network company they use when they come to a local city to grab a car? Uber. What does Uber do? Lines up customers with cars. Did they buy any more assets? Get any more services? Hire more service professionals? Any other good examples of network companies? PayPal. Oh my gosh. He's literally changing, he's basically promoting his own company here. I like this guy. What does PayPal do? We should tell, because I'm sure, let me help you out here. How many people use PayPal and force all their vendors to pay on PayPal besides me? I'm your good customer here. How many people are thinking about using PayPal to deal with enterprise payables? God, you got to help some people out, A few. What does PayPal do? Let's really say no.
We allow buyers and merchants to transact online.
Fantastic. You allow them to exchange information and transact online. Great service, especially if you can get other people to use it like I do, and tell them if they want to get paid in the moment rather than billing me. All they got to do is have a PayPal account. They go, that's a cool idea. You'll pay me immediately. Go, absolutely, get a PayPal account. I don't have to no cost for accountants for my team. I'll pay it instantaneously. It takes out a lot of cost. Don't need to fire those people, what we were just talking about. Buy any more assets. Don't need an accounting software. It's really cool. Use it with FreshBooks. It's cool. Okay, so we see all these network-based businesses emerging. And we're using them. Anybody else uses one every single day? Anybody have any children in this room? Who has children? Anybody? How do you find out what your children are doing nowadays? Facebook, or as my kids call it, the book. So the funny thing is the book, I have to find out my son, is a true story, is in Norway with his girlfriend, not because he tells me. Steve knows my son, not because he tells me, because he's on Facebook in Norway climbing the fjords, right? It's absolutely amazing. And my younger son tells me he's going to break up with his girlfriend using Facebook. I go, really? That's not today's world that I'm aware of. Really cool company. Any assets you can think of in the Facebook world? Did they buy some more assets and put them on their books and records and account for it? Cool. So what I'm suggesting is, everybody know what the hierarchy of needs by Maslow is? Anybody want to guess? Anybody want to tell me what the hierarchy of needs from Maslow are? Anybody remember what they are? Sure, go for it.
It starts with basic needs like hunger and shelter, and I know it ends up with self-actualization.
Fantastic. Lowest level, sustenance, structure, community, mastery, self-actualization. Now, what's really interesting about it, he was not a IR executive. The guy was not an investor relations executive. But let me suggest he had some foresight about investor relations, and he may have been a tremendous CFO. Because he realized, if you look at the chart, we're not doing agrarian here, that he knew at the lowest left corner was sustenance and structure. Cool, lots of companies create sustenance and structure. The real estate industry does, the agrarian industry does. Really cool stuff. Not many people are in it anymore. Only 100 years ago, 97% of us were employed by agricultural industry. Any of you now farmers? No farmers in this room. We know one. Besides, not a gentleman farmer. I'm not talking about a gentleman farmer here with cows, not Circle T. So lower left, someone comes along using the BCG model matrix, and we get sustenance and structure. Along comes after that community and education services firm like the one we're in today. Cool. Something happens. Bill Gates decides to leave college in 1973. He goes, oh, wow, software in everybody's household. His mom says, that's the stupidest idea I've ever heard. Who would ever want some software? Who would want self-mastery, right? So he goes ahead and he decides to build some collaboration, communication, and software capabilities. Salesforce takes it to the next level. But then a guy 30 years later, basically my son's classmate from Harvard, Mark, decides, wait, who cares about software on everybody's desktop? Why don't we just forget about software on desktops and let everybody connect and self-actualize and communicate and share whatever they want to share and stay connected with their families and loved ones? And as Bill says, surprise, what's valuable at home becomes valuable in business. Should come of no surprise to any of us. What's valuable at home becomes seamlessly integrated into our corporate worlds. And the companies that do that, the self-actualizing companies, create extraordinary value overnight because the world's flat and they don't need to build a building or a factory someplace to reach 7 billion people. Right? So, products and services are created. Cars, trucks, toys for boys, people and services, software and data and analytics, networks. And companies are always sort of surprised. Why is my company not doing that well? Well, here's what happens. And you're all CFOs, or CFOs to be. Who measures which here? I just want to make sure you are what you measure in life. Let's see who measures what. Who measures the lower left quadrant? Assets and asset utilization. Who's got a complete inventory of their plant, property, and equipment when you give your financial statements to your board? Who has it? Only a few of you have it, not all of you have that? Cool. Well, most of you have it. How many of you have the intellectual capital and billable hours of your services firms? So you know how many people you have employed and what the billable hours are them and their cost for their billable hours and retention and training and development. You've got those numbers, I presume, right? For your big services firms. Okay, let's keep going up. Who keeps track of their intellectual property? Lengths of code, number of patents, the amount of IP. Oh, cool. Now, who's got the newest ones? Who's got the number of members on their network? Oh, wait, hold on. 2. The amount of time spent on the network. The amount of transactions on the network. The amount of people who attend Salesforce yearly event. What are you up to now? 50,000 people? 90,000 people. How many of you have a user group that come to your yearly event and attract 90,000 people to San Francisco and then, as a result, create a company called Airbnb just to boot from some college kid who's 20? 1. Interesting. So we have 2 companies that are keeping track of the network interactions, the sentiment of the network, the power of the network. Another one is keeping track of how many people participate with the network, the commitment to the network, the social interactions of the network. It's not to suggest that all of you don't have companies, that you all don't have the opportunity to participate in the hierarchy of needs of humans, but for somehow the bulk of us have forgotten it. We somehow forgot that a house is not a home. We understand what this building looks like, but we forgot the people in the building are more valuable and their interactions are more valuable than anything else that comes before. So let me just talk about marginal cost. Everybody know what marginal cost is here? People know what, hands up who knows what a marginal cost is. Great, for all of you future CFOs, you should know marginal cost. Marginal cost basically is the incremental cost of scaling your business, right? Of making something and selling it again. So really interesting stuff. For an asset builder, a person who makes distributes, retails, manufactures anything, it's a lot. Like think of people buy me a car, sell me a car, my newest car from either BMW or Mercedes-Benz. They make it once, they sell it again. It's almost the entire marginal cost shows up again in that car to me. Right? Service provider, the marginal cost of that business is hiring somebody new, locating into the building, training that person, retaining that person, developing that person. Very high marginal cost. Very high. Not as high as an asset-based business, but still very high. Now watch what happens to the marginal costs, and therefore the net profit margins or the gross margin of the software business. Anybody want to tell me what the net margins are of, or gross profits of a simple company like who? Here's the Microsoft person here. Here. What's that number? Close to 100. How many other, besides you three, how many of you there have 100% gross margins? How many of you would like to have 100% gross margins? You need to go see him and these other three gentlemen right here.
Yeah, but his production is below the gross margin line. His production is in the R&D line.
We need to take that up under advisement. Here's the CFO. This is Deloitte, the Gap accounting group over here, who they need to talk about that.
So we are going to talk about that when we get to Q&A. is marginal cost. He didn't say total cost, right? So the other way you start to tell the difference of these businesses is by looking at the balance sheet and the income statement. You start looking at the geography, right? Because in an intellectual capital-based business, all of the cost is below the margin line because it's in R&D. That's the way the accounting tells us to do it. But the incremental marginal cost of selling one more piece of your software is zero. That's the difference. We get into the issue of scale.
So, and think about one next level business model, the network business model. How much more does it cost Facebook for me, literally, to post another picture of my family? Since I literally do it all. It's not like Microsoft or Salesforce or PayPal. I mean, I literally do it all. I'm the manufacturer. I'm the distributor. I'm the retailer. I'm the marketer. I'm the salesperson. I'm it all. I mean, I basically promote their brand. I don't have these salespeople calling me and say, would you like to try my product today? Facebook. No one does that. LinkedIn, I just keep adding more and more content to their network and then promoting it to my friends. And then, by the way, I don't know about any of you, but would all of you, if I were the CIA or the FBI, would you give me as much information as you've given Facebook at this point? Would you tell them every movie and restaurant you've gone to, every college you've been to, all the names of all your friends and family? And then, by the way, would you go ahead and put your fingerprint on the Apple device if they called you in at a local police station and said, we like your fingerprints. Would you mind doing that for us? So what happens is you get these amazingly different scalable business models, amazingly different scalable businesses. And the marginal cost, or the cost of capital, and the amount of capital deployed is so dramatically different in a hyper-connected world that you get billion-dollar startups overnight. Not one, not 10. You get them overnight. And you're going to get more of them because the world's built infrastructure. They built the manufacturing facilities called the internet for the world to connect. And companies who understand that will create on that infrastructure, the public infrastructure, this massively scalable business models. And they'll scale, as you can see, exponentially, not algorithmically, not geometrically, but exponentially versus every other business model that has ever been created. This is not just theory. This is economic reality. So, how many of you, see what you know, I'm now on the board. We're in executive session. How many of you trade for 1 to 2 times revenues? Most of you are public companies. How many of your companies trade in the 1 to 2 times revenue? I did not say EBITDA. I did not say cash flow. I did not say profits. How many of you trade in the 1 to 2 to 3 times? Hands up. So a count. About 30% of you. How many of you trade in the 2 to 4 times revenues, services businesses? A few of you. Cool. How many of you trade in the 4 to 8 times revenue marketplace? Our numbers are shrinking here. How many of you trade in the 8 to 25? 8 to 25 revenue. Who are you? Oh, cool. You're like you're a highly leveraged transaction. I'm an ex-real estate guy. I'm headed up the Hancock's real estate arm. We need to come back and talk about why REITs trade at such high multiples. I don't want to do it for today, given I'm a real estate guy, but we'll talk about it. So, except for REITs, which have special tax advantages, although you can all talk to them about how you become some sort of special tax advantage REIT with a free cash flow business, all the rest of you, none of you trade in those high echelons. Why? Anybody know why? I've given you the hints. Why are these businesses scaling and being valued so highly? Lower growth, absolutely. Anything else? Lower margins, keep going. High use of assets, keep going. Right, threats to their business model, very good. Smaller addressable markets. More established.
Lower risk.
Ah. Lower risk. So let me ask you a question. There's an old thesis in the energy industry about, I'm in every industry, you need to know for all boards. So if I know a few things about your companies, just let me know. If you're in the energy business and you're upstream from the customer, are you more or less risky than the businesses that are downstream towards the customer and have intimate relationships according to investors and customers? Which is the riskier place to be in the upstream-downstream experience? And if you don't even know the energy industry, would you rather be closer to the customer or further from the customer? Correct. What happened to all of us, big company owners, when we decided to outsource all of our most cherished assets, our customers, to Facebook? Did we give away the downstream assets or the upstream assets? We gave away the downstream assets. And what are we doing now to get them back? Who are we paying to get them back? He's giving his own pitch here. It's fantastic. We're paying not only Salesforce, we're paying Facebook to buy them back, right? We're basically getting them to like us back through Facebook. We decided the customers weren't that important to us, so we gave them away. They couldn't have been that important if we would have given them away for free and now paid them back. So here's the exciting opportunity. Every one of you, when you go back into executive session, has networks of something that you can satisfy their needs. Every one of you. You have networks of customers, you have networks of partners, you have networks of employees, you have networks of investors, you have networks of every group of constituency you can imagine. They exist, and all of them have higher order needs. They all have self-mastery, they all have self-actualization, they all have connectivity, they all have payment processing, they all have every need that humans need. They all have needs for connectivity, they all have those needs, right? Salesforce started as a CRM system and it has this funky thing called, today, Chatter. Do you want to tell them what Chatter is? Do you want to repeat that for people who didn't hear it? Anybody want to sign up with Salesforce who doesn't already have? How many of you have Salesforce in your organization? Oh my God, you have a lot of customers to get names from here. Can you repeat that again, what it is again?
It's a social stream inside of applications that allows people to collaborate on content and their workflows.
I'll make it easy. It's Facebook for business. Is that okay? Yep. Facebook for Business. It allows people to work inside their existing organization in a secure way to have a set of communications, capabilities, collaborations, social interactions so that they can stay within their environment to sell more, basically, do more. And service more. He can keep going. You get the point. So they had a network. They created a software network, and then they created a sales network, and now they have a network of users, things like that. So everybody can basically begin to create networks. And networks are not new. And everybody thinks these things are brand new. They're all brand new, newfangled things. Can all of you pull out your credit cards? Anyone pull out a credit card, please? Can anybody pull out a credit card? Will any of you pull out a credit card? I promise I won't take it from you. Even if it's a higher limit than mine, come on, let's pull out a credit card and tell me what it says on it. What's the name of the credit card issuer? Perfect. Anybody else got one there? Perfect. Those are banks. What's the name of the real provider of these services? Visa, MasterCard. These things existed for a long time and are extremely valuable businesses. They've been creating payment networks, not as new as PayPal, for quite a while that create extremely valuable relationships that we carry around all day long with us in our back pockets. Networks are not new. They're extremely valuable, right? And they're there for a good reason now. You can go into the cloud. These are new technologies. They are mobile. Everybody carries around their mobile device. Just give you some really interesting things about these things. How many times a day do you think you all check your iPhone or your Android device? Anybody want to guess at the number? Wow, very good. 200 times a day. Anybody believe that? High or low? What's the under-over on that one? It's more than 150 times a day. That's correct. 150 times a day. We're connected to it. It's like part of our technology. It's like a hand to us. The research says our kids would rather have that and lose an ear, right? It's really clear. It's part of their lives. It's like their Van Gogh. They'd rather have that. So today, how about the cloud? Everybody know the data about how much data we've collected in the last 2 years versus the last 2,000 years? Anybody know that number? Well, let me give you the number. 92% of all the world's knowledge has been collected and created in the last 2 years. 2 years. This is real tough that's coming here and now. Social interactions, analytics, the Internet of Things. It's a quintillion. I don't even know what the number is. Anybody know? I don't know what it is. It's some number. It's bigger than a gazillion, or maybe it's bigger or smaller than a gazillion. I don't know, but it's some big number. It's called a quintillion. 2.5 quintillion new pieces of data are created every single day. And here's why. There's a cultural shift going on. It's called the sharing economy, with collaborative consumption, peer-to-peer exchanges, crowdsourcing, network participation. All of us live it. And every business has a chance to participate in it. So let me give you the numbers. We spent the last 2 years with Deloitte doing some research. We looked at all publicly traded companies. We said, gee, is there some longitudinal view of the world? Can we get away from this industry perspective and see, could we look at all businesses from a longitudinal perspective, from a business model perspective, see if we can make sense of this? Is it really about industries, or is it really about something fundamentally different that all CFOs could begin to think about in their board meetings? And the answer is, we found something interesting. There was only 4 assets that businesses could call upon. There weren't any more, there weren't any less. There were 4. They could call upon natural resources, assets. And every business has to call on the same resources around the world. They could call on the resources of the earth. Things. They didn't like those assets. They could call on the resources of people. Right? These were longitudinal assets. They were completely fungible. They were called services firms. They didn't like those assets. They could call on the intellect of people. They could call on what we knew, not who we knew or what we knew or what we had. Intellect. And then they could finally call on us, the networks of humanity. Who's the Cisco person here? Is there a Cisco person? The human network, right? Thank you. I did another advertisement for you. The Cisco, they could call on the human network. And the human network working together could create amazing things. And here's the multiplier effect. that asset companies are only worth 1 times revenues. Services companies, these are long-term trends, are worth 2 times revenues. So it should not be a surprise to us. So when you're a CFO and you're making a marginal investment, an incremental investment, your CEO says, where should I make my next bet? Where should I allocate my capital? What should I be measuring? The first thing you should say is, let's not spend any more money on things. Services, I don't really like that anymore either. Hold on, intellectual property. There's something really cool out there. And we have it. We couldn't have built things and hired people if we didn't have some. Could we codify it? And by the way, I know we must have some networks because we did have customers who bought something from us, even if we don't have any names of them. We must have some employees, even though we don't have any relationships with them. We must have some suppliers, although they're in our AP department. Right? There's got to be networks that we can take advantage of. Why spend our money and time, our marginal capital allocation, in the things that are least valuable? Those are the numbers, 40 years of study, every publicly traded company. They fall nicely in buckets, and they do for good reasons. They all had to pull upon the same assets. Think of it as like stocks, bonds, cash, and alternatives. Only 4 asset classes for investors. For all of you amazing CFOs to be, there's only 4 asset classes that you can all invest in. That's all you've got. There ain't no more. Things, people, intellects, and networks. And the numbers are staggering. It's not just the economic valuation of companies, it's the economic margin of companies. It's the profits of companies. So it's not just the value's higher, if Mr. and Mrs. CFO to be. It's that the CAGR is higher. Look at these numbers. Network companies grow at 20 CAGRs. Asset companies, 8.4. Services companies, 7.9 CAGRs. How about average profit margins? 15% for asset companies, 32% for network companies. Significantly better business models across every single dimension. Every dimension. Go for it.
So the asset companies have 100 years plus of history. The network companies have a very short amount of time. So you'd expect the growth, I mean, I'm not disagreeing with the numbers, but you'd expect the growth rate to be a lot higher because it's only been around for a short period of time. When you look at Visa or MasterCard when they first came out, that was a network company that dragged down. That number, are they in that same category when they first emerged?
So really good question. These younger companies are in fact smaller, but I was just showing this to Bill yesterday. What's interesting is that the asset companies are disproportionate users of financial capital in the world, as you might imagine, right? Services companies are quite capital efficient. They really don't use much capital to hire people. They're just not. What's more interesting is that network companies are the most efficient, as are technology companies from a capital perspective. What you're seeing in the last decade, we did this over 40 years, is you're seeing not just the capital size, think of it first as the valuation, you're seeing the network capital size, the size of the ball, growing as well. So we just looked at this yesterday through 2014. Asset companies, energy, minerals companies, materials companies used to dominate the top of the market cap sector. They're now down in the bottom half of the top 10. And the technology companies are now at the top 2 or 3 of not just growth rates, but also of the market cap, not just the PR ratios. So yes, they're younger, but they're scaling better as well. And they're receiving, here's the other thing. This is the hard part. For old asset companies, they're receiving, if you look at the research, they're receiving the best human capital and the most aggressive financial capital. They're basically sucking the economy, as it should be, just like we sucked it out of the agrarian age. They're sucking the economy out of intellectual capital and financial capital.
Have you guys, in your numbers, have you considered all the companies that have failed? So you're looking at all these companies that have succeeded, but there's, for every company that succeeds, a whole bunch of capital and expenses that have been spent on companies that have failed as well to achieve a lot of these high-end.
So we looked at only publicly traded companies over the 40 years. Or we can't look at private companies. We can. We're about to start looking at that. It's hard to get a database on that. The private equity guys would have to share their databases. There's really nothing. There's no Bloomberg or CompuStat or Capital IQ for those companies. So all we could do is look at the 40 companies and look at their failures and successes and watch them wipe out at both ends. And we found is they were wiping out equally. The new technology companies were wiping out the bottom. The old asset companies were wiping out the top.
Use your microphone, because some of the guys in the back are saying they can't hear.
So for me, the biggest learning I've had, 20 years at GE, 2 companies in service, one in healthcare and one in call centers and backroom stuff, and now at PayPal. It's observing Apple. And so at the end, they're very true to their model. In the end, they want to sell you more hardware. But the way they've created so much value is that they've created networks around their hardware. So their core economic model is to sell assets, but the reason why they get so much continuous growth and didn't go the way of the other computer companies is that they've created a network that is so loyal and so forceful that nobody can avoid Apple. So I think looking at the Apple example is a great one that says that you can still be founded on assets, but you create your value around the network.
Hey, Barry, I want to add to that point. People have read the retailer that recently launched a phone. Think about it, right? Why did they move into that direction? For exactly your point, right? The research showed that if they had even greater connectivity to the customer, they could sell more of what it is they sell. So they're creating that stickiness, which somebody said earlier.
I said we'll still beat the shit out of them in payments.
I'm not advocating, I'm just explaining.
You get the point here. Even though the debate is clear, networks exist everywhere. The real question is, you go back when you leave today, we're going to have to get through this quickly now, is you have to think about this step. This is what you leave with today. You started the morning with Mike Useem. I'm a faculty member at Wharton as well. You start with Mike Useem. He says you got to figure out which way you're going on the mountain. But he doesn't tell you if the mountain's up or down, sideways or left or right, if it's on fire or not on fire. It's an interesting conversation without context. I think you have a context here. You go back to your CFOs, you go back to your CISO, and we say, God, we have some really proprietary data. And it says which way is the fire burning and which way is it not. And here's the problem you're going to run into. Mental models drive business models, drive investment theories. Simple. Let me say what that means. I am what I believe. I am what I think. I am how I think. This is true not just in business, this is true in life. If I think I'm going to be kind, I am kind. If I think I'm going to make money and focus my energy, I'm going to make money. If I think I'm going to do, what's Mark want to believe in, Stephen? What does Mark believe? What's the article called? Software is Eating the World. Yeah. Does everybody know this gentleman by any chance? We have happened to have worked together in a very difficult period of time. Stock market was 6,000 here, and I were in a road show together. So what is Mark Andreessen is the company he works for?
The firm is Andreessen Horowitz. Mark Andreessen is one of the founders who invented the web browser. Andreessen Horowitz, Mark Andreessen is the founder. He invented the web browser, which became Netscape. He's currently on the board of Facebook, eBay, and Hewlett-Packard, amongst many others. And his most recent claim to fame is coining the term software eats the world. And the idea is, and the principle is, that software is going to eat every single business that exists today in some way, shape, or form.
He has a mental model that believes, and he's pretty much winning this particular debate, software is eating every industry, no matter how you look at it. It's taking more and more of our capital, more and more of our human capital. So he has a mental model that says, I believe software is critical. So when you go back, you have to ask yourself a question. What's your mental model? What's your leadership's mental model? Have you properly identified what the mental model of your leadership is? In fact, do they know? Mike Useem and I were having breakfast this morning. He says the problem with that thesis, Barry, leaders don't like to look at their mental model. They just prefer to keep on doing what they've been doing and hope to God nothing changes. That's not a fact anymore. Things change. So you have to go back and ask, what's our organization's mental model? What is our investment thesis? Think of yourselves as investors. What's our investment thesis? We're not an investment organization, but we're investing capital every day, so what's our investment thesis? Second, based on our investment thesis as an organization, what's our business model? Are we manufacturers, distributors, retailers? Does that define our future? Do we spend our money on only doing that and measuring that and monitoring that and reporting that? Interesting. These are sort of unstated assumptions. And then finally, how does our mental model, what we think, determine what we are, determine the economic value of our business to our customers and our shareholders? How are what we're not thinking determine what it means? So let's talk about network businesses. Were founded as network businesses because they had a mental model of networks, just like most businesses have mental models of software or mental models of hardware or mental models of services, but it doesn't stop you from saying there is a higher order of value that I can serve. And that means every business can benefit from the network revolution. We just heard about it with Apple. Every business has networks. Every business has them, and they're latent. My favorite thing is there was a big, huge chemical company I was working for, huge, hundreds of billions of dollars. And they said, here's the problem, Barry. No one in our organization has the names of all the members of our network. You'd have to ask our CFO. I asked him. He said, we don't have the names of the people in our general ledger. I asked the CMO, any place we have all the names? No. HR director? No. AP director? No. AR director? No. Well, it's hard to basically take advantage of these networks if you don't know anybody in your networks, right? So it's like me going home and say to my wife, Ellen, what were the names of my two boys again? You got to remind me and your cousins. I know cousin Eddie. No, that's your cousin Barry. So 4 steps to success. You can get a copy of all this research from Deloitte. 4 steps to success. 1, get your team, like we're doing today, into an orientation. And ask the hard question. What are the unstated biases, attitudes, and beliefs of our organization? What are we not saying? What are we not thinking? What are we not conceiving? What are we not imagining? What are we doing that isn't somehow shaping our mental model, our investment thesis as an organization that we've not considered? Because just to have a leader who has a vision, he says, I'm going to go build some more shit. Seriously? Not interesting. Not to investors and not to customers. Maybe interesting to him, but not that interesting. Next thing is, after you really understand your mental model, what is really driving your leadership team collectively, because these are self-enforcing, reinforcing systems. These are below the level of the water. You need to assess everything you have. Now, all of you are finance function professionals. Is that correct? Everybody know how to do a DCF here? You can run a DCF on your customer base. Could you not? Can people do that here? Could people imagine doing a DCF on their customer base? Hands up who could do a DCF on your customer. Imagine doing a DCF on your customer base. Hands up who could imagine doing that. How many of you have done that, though? Cool, a few of you have. Great. How about DCF on your supply chain, the way Airbnb does? How many of you have done that? Or Uber, DCF on their supply chain. You can imagine doing that. Or in the financial markets, DCF on your investor base, right? You can imagine doing that. Then you have to think, say, okay, I'm an investor. That's my real role as a CFO, to make sure I allocate capital to the most important project. I'm getting all these project requests all day long from these business guys who think they know what they're doing, but they've never done it this way. They've never looked at what's called CAPM, capital asset pricing models. They don't know the efficiency of capital. I need to do a CAPM pricing. I need to understand what it looks like. I need to look at the capital allocation, determine which of these models will produce the most effective, lowest marginal cost expansion to my company. And then I need to use new measures. And every one of my boards, I can't tell you, we show up to these big board packs, and the board packs are exactly the same, and the board members say the exact same thing. What were bookings last quarter? I always want to say to every board member, could you please read the board pack in advance of the meeting? Seriously, come prepared. Because can we talk about something strategically about what we're going to do to fundamentally alter the economic value proposition of our business? Which means I think it's incumbent upon the CFOs to set that out for their board members. Who you are, inventory everything. These are just sticky notes. Go up on a whiteboard, put down what types of assets you have and where they're located. You can do this with all of your finance function team. What assets do we have? Which ones are valuable? Which ones are less valuable? How do we think about this portfolio of ours? How would we imagine this portfolio? Which portfolio is the most valuable? Which ones matter most to our customers and which ones matter most to our investors? And can we match them like building a financial portfolio? Can we then do portfolio theory? And I don't mean portfolio theory, one business versus another. I mean portfolio theory the way investors do it. Which ones are more capital efficient with lower marginal cost of growth, higher economic growth rates, more economic demand and blue ocean strategies? And then we have to use something called big data. Anybody want to tell me what big data is? What's big data in simple terms? That's sure. But tell me what it is in terms of English. What's financial data? I'll use that one as a correlate. What's financial data? No one knows what financial data?
Financial data is very structured data, and big data is very unstructured.
Unstructured data is big data is unstructured data. About what types of things are in unstructured data? What types of things are in big data? What types of customer interactions, customer sentiment, customer engagement? It's time for the finance function to report to the board. Here's your financial data. Here's your bookings. Here's your revenues. Here's your EBITDA margins. Here's your return on assets. But now let me give you some big data reports. Here's your sentiment. Here's your engagement. Here's the numbers. Here's their participation. Here's the leading indicators of what you can expect far out into the future, because customers are leading indicators of what they think about our business. That's big data. Concepts are not new. Let me prove it to you. Can I get you all to stand up? And then Bill's going to join us again. Can I get you all to stand up again? Now, what I want you to do is to say hello to the person to the side of you again. Now you have a slightly different context. You understand that the person next to you is the most valuable asset in this room. They are here to support you when you go back to your office. They're going to remind you that a house is not a home and that the value of your business is in the network of relationships you have. They are your long-lost loved ones. They will forever love you because you were here with them today. Say hello to these wonderful friends of yours now in a way that they'll never forget. I want to thank you all very, very much for a great afternoon. Thank you very, very much.